Hello and welcome everyone. Today we are joined by three ASX gold companies. We're talking to Dave Reeves, who's the MD of Calidus Resources. They're in construction with their Warrawoona gold project in Western Australia. We've got Milan Jurkovic, Executive Chair at Wiluna Mining, a producer looking to expand, having just raised a little bit of money this week. We'll hear a little bit about that in a second. And Mike Jones, MD at Impact Minerals. They are a prospect generator and developer in Western Australia and New South Wales. Hello, gentlemen. How are you?
Well, thanks.
Good. Okay, today what I thought we'd do, guys, is just look at lessons learned from 2021 and a little bit of 2020 in the sense that COVID brought along a few additional challenges. Mining's tough, but it was a little bit tougher during COVID, and trying to understand some of the lessons learned and how you overcame those, and perhaps how you're setting yourselves up for 2022. I think that's what your investors want to hear. So, Mike, if I can just maybe start with you, and maybe get each of you just to give us that 30 seconds introduction to the companies, and I'll pick it up from there. Let me start with David, please.
Dave Reeves, MD, Calidus Resources. We're developing a 1.7 million ounce Warrawoona gold project in the Pilbara of Western Australia, on track for first gold in the June quarter of 2022.
And Mike?
That's great. So Mike Jones, Managing Director of Impact Minerals. We're a early stage explorer and project generator, and we're about to commence drilling of our Dunia gold project between now and Christmas, and hoping to deliver an early Christmas present for shareholders and gearing up for a big 2022.
And Milan, over to you.
Milan Jurkovic, Executive Chairman, Wiluna Mining. We're a modest producer in the middle of Western Australia with progress now planned where we're expanding production to about 120,000 ounces over the next 6 months, with a view to go beyond that, depending on the successful outcome of a feasibility study.
Fantastic, gentlemen. Thanks so much. I guess the basic premise of this was when we looked at the way the markets were reacting to your stories. You're all busy doing things. You're all busy being busy, but the equities didn't see that love and attention. And precious metals was, in terms of the equities, was under pressure, but the price of gold was pretty okay. Thank you very much. So what do you put that down to, Dave?
Look, I think gold had a very good run in 2020 with the pandemic and everything else. I think recent times, last 6-9 months, you've seen attention switch to battery metals. Of recent times, the gold price softened a bit. Investors have a short attention span at the moment, it seems. Lots of volatility both in how we operate in an environment and in metal prices, share prices, etc. Gold's had a bit of a resurgence in the last month or two, and you're starting to see quite a bit of interest come back into gold as we head into these next uncertain times.
Well, you say that. So Dave, I'm going to stay with you, actually. You say short attention span. Is it short attention span, or the gold companies weren't doing enough to tell their story better in the context of what was going on with Bitcoin, what was going on with, Tesla or battery metals?
Look, I think it's, if you have a look at the trading in any one of our stocks, I imagine it's the same for all of us, is, from a percentage turnover on a monthly basis, it's sort of 3 to 5% of the share register is all that gets turned over. And, so you've got some very long, stable shareholders, but your price is driven by a smaller minority that are, more short term. And that tends to drive you, and they tend to be it day traders or looking for a quick uptick. You do see your price driven more by those than people who just sit and hold because they don't affect the price.
Right. And what about for you, Milan? I mean, what are you saying?
The liquidity-driven increase in equity markets around the world hasn't favoured gold, and we're sort of peak expansion monetary supply. Real businesses with supply lines and issues are undervalued compared to tech and growth. Now that's changing. You can see there's an inflection point. The reason we're seeing so much volatility at the moment is because it's directionless right now. We don't know which way the money will go, and it's all about money flows, essentially. Dave's right. Share prices are driven by short-term traders rather than companies like ours. Our register is very deep to try and get a mine built in the next 3 years. So it doesn't actually trade. It's only the short-term money. The short-term money is more likely still to invest in growth stocks and not real businesses or gold as a defense, because people don't see that need right now, although I think the world's changing.
And what about you, Mike? Because as a project generator, you need to do something meaningful to kind of see that movement or interest in your stock, don't you? Because it's different compared to a producer, say.
Yeah, that's right. And look, the way we do that is just to do our best to give as much news flow as possible. But I agree with with David. The majority of the share trading and the trading in our stock, comes from short-term speculators and traders that sort of get in one day and out the next, or the news wasn't what they were hoping for, and so they move on to the next hot thing. And that's understandable in the space that we're in. But fortunately, the top 10, 20 shareholders, always been pretty stable. So it is that short-term churning, and that's very much directed by the market sentiment on the day. And Impact's more of a multi-commodity explorer, as we've discussed, but we're not as affected by things like the 6-month downturn in the gold price. But that's certainly affected the sentiment across the whole of the gold sector. Very much driven by that, the gold price. But in the context of what's happened in the last 20 years, gold's up nearly tenfold, and so the long-term trend is still up. So long-term investors are going to be rewarded, I think, still.
So there is a case of they'll be back. And part of my question was, is there anything the gold producers, gold companies, gold generators could have done to tell the story better, or is there just too many moving parts and you just kind of resign to, well, the market will move in ebbs and flows and you just deal with it?
Look, it's certainly driven by the short-term traders and market sentiment driven by the metal price, in particular gold. If gold's up, $50 or down $50, all the major gold shares just take the hit or the jump on the day. So that's where it all comes from.
Dave, what do you think?
No, look, I agree. We obviously all try and tell our stories and keep shareholders informed as much as possible. And the more you inform shareholders, the better. They can make informed decisions. But at the end of the day, sentiment is a massive part of where share prices head, and sentiment is something that, as much as I'd love it to, I don't think any of the three of us can control on the market.
No, I don't think you can. And like I said, that's why I mentioned it's a lot of moving parts, because a lot of gold companies, and you all act independently, as you should. You look after your own shareholders. But I just wondered if you'd sort of seen and sensed, as Mike says, in the last 20 years, it's behaved a certain way. Now, with social media coming through, we've seen various squeezes happening. We've seen a lot of a move towards sentiment and influence of a number of limited parties. You don't necessarily worry about things like fundamentals, or if the gold price does move, $25, $50. It's more extreme, it feels. Well, does it feel extreme to you, Dave?
Look, without a doubt, the rise of social media, investor platforms, chat rooms, in particular on smaller companies, can have a massive effect. It's a little harder on the bigger companies, but it is still out there. We've had a couple of nice upticks this year from research reports or mentions from groups that I've never heard of that, previously have done their research, said some good things about us, and, all the social media and everything else we've done as a company pales into insignificance versus the traction that some of those forums got. So, yeah, without a doubt, marketing where you market is important. But at the same time, there are other factors out there. Investor groups, various investors who have huge followings that can influence your price a lot more than you can as a company.
But does that feel real to you, in the sense that it's nice when they write nice things, but when they write not so nice things based on not a lot of data, you get negatively impact, and that happens too. I mean, how do you feel about that?
Yeah, look, I mean, I think it is what it is. You have to take the ups and the downs. So, yeah, I think it's it's an area where certainly the regulator here is getting more involved. You've got ASIC getting onto these forums and reminding people of the various financial regulations that they should be following. So they are trying to crack down on false, be it positive or negative, news. So the regulator, I think, is very aware of it, as we all are. And as a company, all that we can do is deliver on what we say we're going to do, and then the proof's in the pudding. And I think that's always been there and always will be there, is do what you say and people will believe in you. And if you don't do that, then you should be open to taking fire.
I mean, how do you feel about that? Obviously, maybe it's the job of ASICs to monitor and measure this, but when people talk about your company negatively, do you just put your head down and say, look, we'll get on with what we can control and let that play out, or is it really damaging?
Look, you can only deal with the things you can't control. You still need to, as Dave said, market your company. You've got to be in front of shareholders. You've got to be in front of the people that are relevant. Just going back to when you started the conversation, I'll go back to this quickly on Bitcoin. The one thing that there is no need to explain, or people can, Bitcoin is 100% correlated to the equity markets. There is no other, it doesn't have any other special factor in investment. If you go and look at the correlation over the last 5 years, whereas gold is commodities cycle is commodity price correlated and also defensive correlated. If you look at a percentage of gold in any investment, when the world goes into a fear and defensive mode, gold will have a much bigger part of a portfolio. The private money I'm dealing with, and I'm in a company, as you know, that's had a difficult background that I've had to clean up. So trying to get the message away from people that actually know the answers already without listening to the solution or what the problem is all part of the messaging, right? We are still trying to move in that space, but the only way you can do that is to deliver on your results. Profits and cash flows will eventually overtake noise, and the scale and leverage to a commodity cycle and the quality of the asset, if you can reveal it, but you need money and following. That's why I've had to go into deeper pools of money to build the product before I'm worried too much about the sideshow, which is the trading around the edges, which is important and helpful, but it's also a distraction that we can't afford because it's a large, as you can see, we've invested a lot of money in the last 18 months to actually prove to the market and our shareholders are convinced, by the way. We brought in some pretty deep money even now. We've brought in 2 new ones. The 10th largest gold company in the world has joined us on the register. One of the largest investors in the gold industry in Europe has come in privately because we've convinced them that, in fact, the scale and depth of the asset we're dealing with and where it's going to go in the next phase in terms of cash flow multiples is worth investing in that risk, and that it's probably de-risked now relative to 18 months ago. However, clearly our share price hasn't shown that. We've traded sideways with all the extra money and investment we put in there. That disappoints shareholders, obviously, along the way. But you've got to try and hold them together to stay the course. The other side, when you get to the other side, the response is actually pretty quick. I've been there before. When the product is clear and clean and delivered, the market will look after itself in a lot of ways.
I think that's right, but there's also a hump to overcome. If there's like false narrative in the market or a narrative which is less than accurate, which would be nice. Shorting happens, naked shorting happens, and that is and that takes time because most CEOs say to me, I don't know what to do. I don't know what to do. All I can do is get on with the day job and hopefully create some revenue or create some stories which will eventually get rid of it. But it's a real hump to get over. I mean, do you think shorting is part of the market? You got to suck it up, or do you do what you were talking about? What I'm assuming you're talking about is say, well, look, if I can go and get some deep capital pools in here, it might scare them off. How do you play that?
Yeah, well, longs always beat shorts if they're long enough to support you. That's a fact of the markets. And if you've got deeper pools of support that's long versus the short-term trading, we're not affected by shorts because we don't have any short-term trading, especially it's very small. In fact, our problem is that none of our shareholders are selling, to be quite honest, rather than because they're holding on for a completion that's not done yet. We're still trying to get to an end product. But yeah, shorting is a factor in some companies, a big factor. But long funds that lend stock for shorting are partly responsible for that product.
Right. Yeah, I think that's a conversation that will run and run. Mike, I mean, for you guys, because you're sort of operating at you're the genesis of all of these projects. At some point, obviously, Dave and Milan's projects were where you are now. Does social media have a much bigger impact for you? Because it doesn't take much to move the needle. It doesn't take as many positive messages in the market to work for you, or is that not true?
Yeah, no, very true. So, one of my main sort of target markets for my announcements are the handful of people on Hot Copper who actually know what they're talking about. Many of them don't, but and they're quite happy to say that.
What's that ratio? I'm interested.
Yeah, a handful.
Yeah, okay.
And we've got some very good support. And so, and because then some of the strong scientific aspects of our story then actually get repeated and told strongly to the relatively less educated or informed groups, on there. But I don't go to Hot Copper. My guys sort of monitor it, obviously, just to see there, because it's never good for your mental health in an exploration company. And I think during 2020, I varied from Dr. Dolittle, which was an excellent metaphor. And so I was walking up and down the corridor here singing, he walks with the animals and talks to the animals, through to master chess player, as one of my deals sort of came through. So, eventually you just get this sort of, it's just a wave of noise and rubbish that goes around. But you have to be very targeted in terms of who you're speaking to there, ignore everything else, but knowing that it is a very strong force. But like Milan says, and David in the same way, is that in the end, it's only results that speak for themselves. Everything else is just kind of noise. And so you just have to put it behind you, and even though we're a completely different space to the other two, and just do the drill programs and do what you do.
Yeah, I think it's good. Ignore the hype, ignore the noise, get on and do what you do. Well, here's the bit I wanted to talk about, which is really around Western Australia. You're all in Western Australia. At points during this COVID, I thought Western Australia was going to separate from the mainland because you guys are isolated.
Which might still do that.
Which is, it's a good thing. And it's also, it makes it difficult as well, because obviously you've got to get people in there, workers, equipment, service providers, et cetera, et cetera. So, Dave, what are the I guess challenges that you've seen this year? Because you're in construction up at Warrawina now, and you've got to get things moving. Has it slowed things down?
Oh, look, it's been certainly the last 6 months in particular has become a lot more challenging. There is a dire labour shortage in WA mining in particular. The construction not so bad at the moment, but there is a lot of construction projects underway, be it in civil around Perth or new gas projects, which soak up a lot of people. So from a personnel point of view, yeah, we're seeing issues across the board in mining, and seeing a lot of companies talking about that, operators and just getting enough bums in seats to operate machines. And there is a hope when the border eventually opens, hopefully let's call it February next year,
2030,
we'll be
hearing
everything crossed,
yeah.
that will help relieve some of the pressure. But in the meantime, talk about gold, we should be talking inflation, and we're not seeing, I think Reserve Bank governors talking, we're seeing minor inflation and it's just going to be transitory and all the rest. We've seen massive jumps in labour rates, probably from our fees up 15 to 20%. Concrete from the start of our build to where we are now is probably up 75%. Polypipe is up 35%. Steel balls is up 35%. Cyanide up 10%. Some of these are blips that will come back down. It's all to do with supply shortage, and a lot of that shipping delays and all those things you hear about as well. And we expect, some of those inputs to come back down to more normal levels in the next 6 to 12 months. But you are seeing, massive price pressure because of shortages. Just formwork, wood for formwork. The guys doing our civil works had just finished ours. We're saying there is none left. We can't get our hands on some for the next job. So, there's been a lot of pressures in that regards, and certainly I think Milan's finishing off his build as well. I wouldn't want to be starting one at the moment. I think that would be very tough.
Very tough. But what do you do about that? You can obviously tie in some of the costs at the start, but not everything by the sounds of it. So inflation's here to stay, whether you think it's transitory or not is a call that you're going to have to make as a company. So what have you been able to do to mitigate it?
Yeah, so from a construction point of view, we had a lump sum turnkey price for our plant, and GR Engineering, our contractors, forward ordered a lot of the mechanical steel and whatnot and locked in that, so they weren't affected, and nor were we. We've locked in a 7-year gas supply contract before the LNG price went crazy. So that's for our power station and gives us that power price, a fixed power price over 7 years. But there are certain things that, be it labour or be it other things, that just rise and falls with the business that you need to absorb.
Yeah, like, just put it in consumer terms, we've seen that with, hand sanitizer and food and toilet paper going up, but you expect it to come back down is what I'm hearing from you. Mike, down at your end, it's all about the people. How do you spend your way through this, or do you just hunker down? How's a project generator come at it?
Yeah, so a couple of things. Certainly, access to drill rigs, obviously, is everyone's moaning about that. We've got lucky with our upcoming project. We had a personal friend that owns a drilling company, so we've been able to get one at relatively short notice. But yeah, now accessing caravans, 4-wheel drives. My guys are out at the moment clearing. There's no cars to hire in Kalgoorlie. You can charge whatever you want for a 4-wheel drive in Cal. They have to hire one in Perth and drive up there. So just adds time and money to everything that you're doing. So inflation is certainly here in that respect, and I don't know how transitory it's going to be. And in terms of labour hire, trying to get experienced geologists. I've been looking for a senior geologist, sort of 15 years experience. Interviewed probably 3 or 4 people. The minute their employers get wind that they're going, then the salaries increase, and way beyond what we can afford, because I'm trying to attract people out of larger companies, and it's not as secure, etc. So yeah, we're seeing, so the 3 of us that are here are still working even harder. So it's going to be an interesting year next year for sure.
And so Milan, obviously you've got a little bit of production going on, and you've raised a big chunk of money this week to presumably get things moving and drive the production up, but you've also got to deal with what the way you worked before COVID, which was a sort of just-in-time strategy. I think it's fairly standard in the industry, through to now where you need backup infantry on site, don't you?
So look, addressing those points, look, I've just come through the US. In fact, I'm based in Knightsbridge temporarily at the moment, because one of the issues is that, Australia is a net importer of capital. Our company is actually owned by mostly European, German and North American shareholders. So for me to do what I just did, I had to be here where the capital is, because I couldn't bring the capital to where wants to look and see, which was a task in its own right, convincing people to invest in something they can't send people to look at and walk. We're a net importer of skilled labour. We're probably at the moment, after these 18 months, somewhere around, in my estimates, about 500,000 people behind the zero base of skilled labour required just to maintain rather than grow. So one of the things you don't want to do as a company where we came from is go back to just in time. However, I can tell you right now, the thing I'm hearing all over the world is that building something real, maintaining supply chains, holding a business together is getting harder and harder. Now, if it is harder, and it's going to be harder to make a decision to bring volume into the market when prices are rising, then clearly commodity prices probably are going to stay reasonably high in the short term. Inflation will hit. Bringing capital projects to a point of decision in this environment, particularly large ones, is going to be very, very challenging, unlikely to happen. So big decisions are going to have to wait, because you can't go and lock in a contract for a 3-year construction project at the peak of a cycle. That would be just reckless in and particularly big projects. So they're the challenges. However, having said that, they're the things that differentiate, if you like, the real companies from the pretenders. You can't blame the environment for not being able to grow and execute your plan. You may have to change your plan. You may have to slide and move when you make decisions and how you execute, rather than saying, I've decided, I've done a feasibility study, it's economic, I'm going to start now, right? That could be a deadly type situation for shareholders if you choose the wrong time for the wrong reason. Okay. But there is no doubt that we're in for a fairly tough period. And I could just recently, I've been talking to various people. There's more people with funds interested in investing and getting offtake or getting some benefit or an EFT. Not many people want to build businesses. It's becoming harder and harder to build and operate real businesses. Now that's a positive for a company like Dave and us, where in fact we're at the point where we're turning all that effort into reality, where the business is built, and then we can incrementally expand on it. If you look at government approvals all over the world, even WA, I mean, it's going to get a lot harder if you're a new project or even incumbent, to get an approval for anything, because the bureaucrats are slower. Things have just ground to a halt. Things are taking longer. Okay. So I feel good, because I think having gone early and got to a point where our cash flow is a commercial production within 6 months, and we can then, we would like to get to 250,000 ounces a year production, which was going to, that's the next challenge once we know how we go about it. But the beauty for us is we have deep enough pockets around us where we don't have to rush into it to the next stage. We can wait. And some of these things might need to be waited on.
Yeah, well, I want to come back to that, but first, you reminded me. Mike, for someone like you, how does this affect your opportunities? I know you've got something away recently, but was it made harder by the fact that people are looking at this environment going, I'm not quite sure, what we should be doing with our money, because I'm not quite sure what the future looks like. So these kind of farming opportunities that, I guess would be, the conversations might have been a little bit easier pre-COVID. Have you been held back in any way, or conversations slowed down in any way?
Not really, and part of the reason for that is that with the exception of the first sort of, say, 6 months of COVID, since then we've been in boom times. I mean, we're in boom time now, and it's unbelievable. And so a lot of people have made a lot of money out of shares in the last 12, 18 months, and so as a result, there's money left, right, and centre. So there's no shortage of funds to for everything from speculative drilling like ours through to the production that the Milan has. And just out of interest, we do have the same common shareholder, major shareholder, and so which is good for us. And they've been very supportive. So yeah, so look, really, it's the best of times right now.
Right. Okay. And Milan, I'll just come back to you on this money question, because whilst what you say is true, the market is needing to evolve in terms of the way that it finances projects. I said something the other day, I think the most exciting thing that's happened in financing world in terms of innovation is probably royalties and streaming, which has been around for a long time now. Do you think that with the kind of ESG conversations that are now prevalent in every conversation, the zero carbon initiatives which are being demanded by shareholders large and small, we're going to start to see either cheaper money from funds, if you meet those criteria, or different types of fund structures moving forward? Because you talked about large capital pools. Was that conventional or not?
No, look, that already exists to some point. There's differentiation between international funds who will measure you on ESG carbon footprints in the sort of institutional space, not necessarily as much in the private space. On the debt side, yeah, I mean, on the debt side, if you can show particularly deep, long green power that goes out 20 years, you can finance it over 20 years, which was unheard of a few years ago. So those products, and they're being peddled now in terms of availability of money. Mike is right. There's been a lot of equity, but there is also lots of pools of money that's made money in growth and equity stocks that's piled into private and family offices with streaming or royalties. There's more than I've ever seen coming through North America, and here in London now. There is many, many more products than I've ever seen. I think there's probably more money than product, to be quite honest, for that type of investment. It's not a favorite investment that I like, because if you're a public company in particular, not a private company, really standard equity and debt is what people on the market understands. And if you can fund yourself, now you can't always do that, but if you can fund yourself by those means, you're probably best to stick to that anyway.
Right. What about you, Dave? What do you say?
Yeah, look, very much so. I agree with Milan on, if you can do debt and equity, it's well understood. And that's why, in some ways, I wouldn't say I don't care about our share price, but we don't need to raise money at the moment. We're going to get into production, all being equal, make good cash flow, and therefore, quite often you're most worried about your share price if you've got a raising coming up because it's the amount of dilution, etc. And that's why, this noise and other things, I'm quite often not overly concerned. Even I'm a large shareholder in Calidus itself. I'm not overly concerned because I see that in the longer term, as we keep going back to, if you produce the results, the rewards will come. So again, lots of different pools of equity. There's a lot of money that's been printed in the world of late that's powering a lot of things, and everyone's saved a lot of money. And I was reading an article in the paper today about a lot of the millennials in Australia, can't see themselves buying a house, so they've gone big time into punting shares, and you're seeing this wave of new money coming into the stock market as well. That's pretty keen on shareholding. So it is, I think, back to one of the original comments, it's a volatile world in which we live, and both where capital's coming from, where it's getting allocated to, and it's trying to navigate your way through the ever-changing environment.
But how much does this narrative, like I said, you've got your money, you're in construction, it's fine. And Milan, you say you found it easier to raise money in Europe, but how much of this ESG narrative is changing the way that mining companies actually behave, or is it just a rebadging of something that's always been there? In your opinion, Dave?
Well, I think, to be quite honest, mining companies, have always been conscious of the environment and being energy efficient. We're a lot more heightened now about going the next level, because if you go the next level, demonstrate that you can, reduce your carbon footprint, increase your energy efficiency, look after your water, be I guess more responsive to your community potentially, although I think we always have been, because we can't operate in communities if we're not. Then you document it in a way where proxy advisors and funds meets their sort of tick box criteria and reality on the ground, you will get a deeper pool of money. There's no doubt about it, particularly general and some specialist funds that won't invest in companies that aren't showing a clear path to behaving that way going into the future. So I think it's a positive outcome, by the way. I don't think there's anything negative about it. It's just that it's also sending some signaling out there where companies are trying to put signals about what they're doing when they're not actually doing it. That's the unfortunate thing. I mean, you've got to actually do things on the ground to be that, and not just document it.
So how do you guys, like a producer, a soon-to-be producer, compete with projects around the world? Because there's an internationalization of investing. Aussies can invest in Europe and North America quite easily now from their phone, and the reverse is true. When you've got Canadians talking about cheap hydroelectricity, which is obviously the cheap is good, but also the fact that it's very, very green. You guys in Western Australia, you've got lots of sunshine, not a lot of water. So how do you tell your version of the kind of zero carbon or the green energy story?
Maybe I'll jump in on that one. In that, I agree with Milan. Is that mining companies have always been conscious of not just the environment, but all of these things we're talking about are input costs as well. If you can get cheaper power, use less water, use less reagents, be better in the community, they're things that we've always done. And I think the ESG is a way of standardizing and making sure people report on it. So if there are people out there not doing the right thing, it's pretty obvious. But I think we're putting in solar farms, we're putting in batteries, we've got gen sets that can handle hydrogen. All of that is ongoing. And at the end of the day, maybe it's slightly the cynic in me, but people are looking for a return on their money. And ESG might drive some people one way or the other. If they've got two equal projects, they might look at the ESG and say, well, I'll put my money into this one rather than that. But at the end of the day, it's all about making money for your shareholders. They want to see a return. They just want to see a return done in the best way possible under the ESG guise. And yes, there's definitely greater pools out there, but at the more junior end of the market, I'm not sure it's as important as the bigger companies, when they're dealing with the multinationals and whatnot. The really big funds are perhaps more driven than the intermediate funds that invest in the more junior mining space.
It's interesting you say that. I kind of give an example of a conversation. We did a survey last year, and I think that other people have too, with regards to how much money people would be prepared to pay for renewable energy versus conventional energy. And I think it's overwhelmingly, yes, not a problem with that. Definitely would pay more. And then this year, when we've sort of seen bit of an energy crisis and supply issues, and prices going up 4 times, of course, not so good. People are revolting against that and don't like it. So what people say and what people do, I'm interested that you would position it like that, given the amount of conversation that's going on in the marketplace. You think at the end of the day, investors want to make money, and that's going to be the key driver. Is that what you just said?
Yeah. ESG is important, but they want to make money.
Yeah. But your point, Matt, look, you can have the cheapest, greenest power anywhere in the world. There's 2 things you need, though. You need a project near that power. So the project starts first in the location, then the availability of power. The other thing is larger companies with basin-style size assets can expense power capital over 20, 25 years and access export finance and finance that goes where you can then lower power down to compete with the hydro projects in Siberia and Canada. I mean, Siberia is the same. Russia generates power at 4 cents US. That's why they can use pressure vessels very cheaply on the coast. Ours is somewhat longer. Now, there are things in WA, like for we are, if you've got a long enough project and you can expense it, we have wind that blows on either side of the day and sunshine during the day, and only a small period at night where, in fact, the nature doesn't generate power. But to go down that path, you have to be very careful that you're going to make money out of it and you're doing it for the right reasons. And even if you put capital in for that, which you might be able to do after you do all the studies, the maximum penetration of that power is maximum 50%. You still need your gas base load in remote as WA. And luckily, we've got a pipeline that goes past that door. But it does lower your carbon footprint. It not only lowers your carbon footprint, it gives you a hedge against hydrocarbon costs, which are going up at the moment, right? So, in fact, doing it is not just a question of green; it's a question of also economics and having a long-dated power to make a long-dated capital decision for your expansions or processing facilities or whatever.
So, Mike, we've been talking about zero carbon initiatives and that whole narrative. For project generators, are you ESG? Are you zero ESG in the sense that it doesn't really affect you?
No, not really. I have had a couple of questions from various funds that I've done presentations to during conferences over the last 12 months. For the first time, asking me, what are you doing on that particular front? And it's something it's hard for a junior company to do, but I mean our main footprint is diesel, so it's not petrol in the drill rigs and petrol in the 4-wheel drives, etc. So really the footprint that we have is really small. But we, Impact supports community projects in the communities we work in. We sponsor a after-school arts and writing project in New South Wales, which is predominantly for disadvantaged Aboriginal children, and I've done so for sort of 4 or 5 years. And like the guy said, that was driven by the fact we were working in the community well before it became trendy to do those sort of things. And and you'll find that most of us, most juniors are doing something small in the various communities that they're working in as a contribution back to the societies we're working in.
Interesting. Dave, just on this, I kind of want to sort of move towards a kind of conclusion here, because you guys are in control of your projects in your necessary and different ways. But Dave, when you look back at the way the market has behaved, and it feels like it's behaved differently from the past. There's a new set of rules, it seems, or slight change. What have you learned? And how's that affecting the way that you kind of move the company forward? Or you just think, well, I'm just applying the same old rules as before. I'm not going to get caught up in this maybe temporary, transitory narrative. What have you learned?
Look, I think a lot of it is the same old rules, which is deliver on what you say, produce the results, and it will happen. I think the changes are the communication methods and styles and how you do that. We're very active on social media, putting up posts 2-3 times a week of what's happening on site, so people can enjoy the journey with us and understand what we're doing, and hopefully understand a bit more about the project. So the style of communication has changed. I think one of the things, it's Milan and London. I don't know the last time I saw a CEO or MD from Perth overseas or outside Western Australia who managed to escape. And, I think Zoom meetings, will be there for 70-80% of calls. You'll still need to get out. You'll still need to have face-to-face. All of that will be there. But just the methods of communication with shareholders, both institutional and retail, I think have changed in the last couple of years, and that will stay. I don't see that, but I think the fundamental drivers of your company and value is results driven.
Right. Milan?
Look, there's no doubt that communication methods that we were used to in the past with press releases and a guy have changed. So social media is a much bigger part of getting your message, not just externally, but internally as well. And it's also the way you communicated to get the attention of people in a shorter sound bites to a large extent, but with the story clear. But as Dave said, 100% agree, quality minds are built on quality geology, quality execution and delivery, and then you get your rewards when the cycle is in your favor, or you're producing cash flow. So when you do all that and you're in the right space, you'll have high values. When the market goes sideways, you'll have low values, but you'll get support in the market. And I believe every company will get that. Now, in the short term, like now where you've got lots of companies drilling, lots of tech stocks, lots of growth stories that promise without having to show a path to delivery, getting higher value than companies like mine and Dave's, people get a bit despondent, but the rules haven't changed. Your business still has to be built on fundamentals and deliverables.
Does that frustrate you somewhat, Milan? Because we talked, someone mentioned, about the last 20 years. Does the behavior of the market just repeat? Is destined to repeat in terms of the human psychology of how they react? That we talk about the Lassonde curve, and yet in the same breath we talk to people about be contrarian in your investing. All these messages are very confusing and conflicting at times, but the behavior is always the same. Does that frustrate you?
Yeah. Look, markets are driven by liquidity. And liquidity is driven by greed and fear. That's a well-proven fact. There's enough research done on that. That's the human behavior of investment. Right now, greed is driving the markets, with a bit of fear starting to kick in. A fear is 3 times the driver of greed when it kicks in. It can be a devastating impact on markets when it happens. But that's how people invest. It's on sentiment. Fundamentals eventually always kick in. They're the underlying factor, and they'll come back to the fore and be real. But when markets are driven by liquidity and sentiment, there's no fundamentals associated with that.
Yeah, and I guess there's another conversation to be had about how many people actually end up making money, or certainly not losing money in that. And Mike, what about you? What are your key learnings over this period? Because you guys have it tough from the beginning to try and get interest and stimulate interest. But once you've got a few things under your belt, people start being a little bit more interested, don't they? And does social media help you guys?
Yeah, no, look, it certainly does, and we've certainly increased our footprint. And as I mentioned, I've been a little bit loath in our space because failure is more common than anything else. You just open yourself to, to just being lambasted and trolled. And so I've been a little bit loath to sort of go too far down that route, to be too accessible. But that's more just to guard our own sort of well-being. But certainly, as the story develops and we get a discovery, it's a great time to be spreading that message, on social media. And I'll be making guest appearances on Hot Copper.
Whether you want to be there or not. Okay, guys, why don't we wrap up? And Mike, I'll just start with you. Just give us, actually, Dave, I'll start with you. Let's just give people some of those moments to look for in 2022 as far as your company's concerned.
Biggest one for us, pouring gold, second quarter, calendar quarter of next year. Exploration rigs turning later this year, so we'll have results. Same time, we'll be putting out our feasibility for expanding to 130,000 ounces per annum. So we can push the button on that once we sort of bed down the first stage of Warrawoona, and then the sky's the limit thereafter.
Time for a re-rate. Milan, what about you?
Yeah, look, our deliverables in the next 12 months are pretty clear. They're fourfold. We need to commission a concentrator, deliver commercial production at our stated production, rate at 120,000 ounces by the middle of next year. We need to deliver a feasibility study for expansion to double that size, and we need to maintain our aggressive discovery and drilling, reserve development, and resource conversion, which is really quite a big driver for the company. We see this asset being a lot bigger than what we're scratching at the moment, and it's trying to reveal its size while we're trying to build a meaningful business in the process.
Okay, and Mike, you've just done a deal, but were you expecting more of that?
Certainly looking for more deals and various discussions in place. But look, the big news will be start of our drill program on the Doonie Gold Project between now and Christmas. My theme this year was rolls of the dice for the big win, and this is our last roll of the dice for the year. But certainly 2022, keep your eye out on our wheat belt projects here in WA, sort of in the same terrain as the Julimar discovery. Got some really exciting early stage anomalies there that we're going to be following up, and I think we're in for a big year next year for impact.
Fantastic. Well, look, gentlemen, we'll wrap it up there because we've taken up enough of your time. I really appreciate that. Some real new insights for me there, and some some topics which I guess much discussed and much debated. We'll stay in touch with you in 2022, see how your stories develop. Appreciate your time today. Thank you.
Thank you.
Thank you.